Good evening, everyone. Time for another silver update. Now here is the daily chart of silver with the trend line drawn in. I've drawn in a couple of lines here. Actually, let me put the tightest one here that's going to touch down to these two touch points here. So the most liberally, most conservatively drawn of these trend lines, you can see we have penetrated out of that downtrend. So what does that mean? Well, it's important. I think you can see that the market did react on the breakthrough of this one. This middle one is the one that I had been watching very carefully, but as I pointed out, it was just a matter of time before the market was going to break out of these. You can see that the steepness of this downtrend, you can see that by the beginning of fall, we would have been down to $18, being a breakout of the trend. So obviously the trend couldn't continue. The question is, will this be significant? I believe it will. But and then of course the other big thing that we're watching is going to be that monthly MACD breakout, because that's going to be the next thing that is going to signal the end of this 3+ year bear phase. I'm not going to call it a bear market. Those things are speculative as for definitions, but the fact that we're up above or nearly this price at the 2008 high, it still allows me to draw a straight trend line through this market, say back from 2003 where it started, that shows the general uptrend of this market. So I'm going to say that this is still a bull market. And this is a very dramatic bear correction in that bull market. Now, of course, if we turn around and go down and go below, then at some point we're going to have to admit that it is in fact a bear market. But we'll watch this very carefully on the MACD. I'm expecting a turn up before fall. This is a lot more difficult to turn around, obviously, because these are monthly bars. So this is the June bar, and when that completes, it's going to give us a change of this. Up move in July and a close of a blue candle in July probably would give us the cross, but certainly one in August. So that's what I'm projecting. Now on to a couple of stories, or the main story of the night. This is from Zero Hedge. Fed prepares for bond fund runs, looking at imposing exit fee gates. Now, I said for the longest time about all of these paper assets is that they're going to steal your money. They've intended to steal your money the entire time. They're going to have to find excuses for it. I talked about, for a number of years, I talked about 401ks. It was my opinion that they were going to crash the stock market and then introduce some type of bond fund retirement. So I was surprised when the president gave his State of the Union address and talked about the MIRA. Now that seems to be kind of like dead in the water. I don't think anyone's even talking about it, but he brought it up when the market was high. These are things, again, that are being brought up when the market is high. Looks like somebody's afraid of a crash in the bond market. So let's read through this and try to see what's behind this. It was 2 short years ago that the Fed, in its relentless attempt to push everyone into the biggest equity bubble of all time, did something that many thought was merely a backdoor ploy to forcibly reallocate capital out of the $2.7 trillion money market industry. Sorry, let me make this larger so everybody can read it. And into stocks when, as we wrote in 2012, July of 2012, it contemplated imposing suspensions of fund redemptions to allow for orderly liquidation of fund assets. In other words, gate money market funds. Since then, various iterations of this proposal have been attempted either by the Fed or the SEC. However, due to stern industry pushback and the relatively modest amount of money at stake, the attempt to force investors to rotate their funds out of money markets, because it is quite clear that if the Fed is hinting at gating issues with a given asset class, it's only a matter of time before the hint becomes a reality, has failed. And as a result, the total amount of notional capital held at money market funds has been largely unchanged in recent years. Here comes number 2. Only this time it is no longer aimed at money market funds, but that other most hated by the Fed asset class, bond funds, whose relentless inflows, we shouldn't have to remind readers, are the main reason why the propaganda myth of a recovery and the resulting con game keep crashing and burning, as it is impossible to spin a 2.5% 10-year yield as indicative of anything remotely resembling a recovery, and shows at best a semi-deflationary world. Said inflows are also recurring evidence that whatever retail money remains unallocated continues to go into one asset class, which is actively disparaged by the Fed at every opportunity. In brief, if anything, the Fed would prefer that all retail investors pull their money out of bonds, bond funds, and money markets, of course, and invest them into 100 times plus PE biotech stocks, because after all, today's stock market is nothing but the biggest Fed-propped Ponzi scheme in existence. And in order to achieve that, according to FT, so here's the article here. You click on this. This is FT, the Financial Times, which is the London paper or website. And we click on that, and guess what? The article's not available. It's a premium site. Isn't that a little bit strange that the Fed is going to be leaking out trial balloons through FT and through a pay site, no less? So that's pretty ridiculous. But we have this article over here from our friends at Barron's, who apparently got some of the scoop here from the story by Tom Braithwaite. So let's read this. The Financial Times reports Federal Reserve officials have discussed levying exit fees on bond funds in hopes of avoiding a potentially damaging run on the $10 trillion corporate bond market. So they're worried about a run on bonds. Officials are concerned that bond fund investors, as with bank depositors, can withdraw their money on demand even though the assets held by their funds are long-term debt and can be hard to sell in a crisis. So they're not only concerned about money market funds, but they're also concerned about bonds. Now, the question would be, why don't they just raise the interest rate or drop the price, and they shouldn't have any problem selling them? That is, unless there just are way too many of them out there, way too much debt out there, and not enough cash to buy it, which is what I suspect. The Fed discussions have taken place at a senior level. That's his source, apparently, for FT, but have not yet developed into formal policy, according to people familiar with the matter. Quote, so much activity in the open-end corporate bond and loan funds is a little bit bank-like, Jeremy Stein, a Fed governor from 2012 to 2014, told the Financial Times last month, just before he stepped down. Quote, it may be the essence of shadow banking is giving people a liquid claim on illiquid assets. Exit fees would seek to discourage retail investors from withdrawing funds, thereby making their claims less liquid and making a fire sale of the assets more unlikely. Introducing exit fees would require a rule change by the Securities and Exchange Commission, which some commissioners would be expected to resist, according to others familiar with the matter. Such fees could be highly unpopular with retail investors unable to access funds without paying a fee, but some in the industry would welcome them. BlackRock, there's the new evil empire, BlackRock, the world's largest asset manager, has called for international rules setting exit fees on some funds. In other words, now they've got your money, they don't want you to be able to take it out. So we'll jump back to the Zero Hedge article, but the main thing to keep in mind here is, what is the purpose of this? Of course, that's what the next couple of hundred comments are discussing, is what is the Fed intending by this? Are they trying to get people to rush out of these bond funds and into stocks because they're trying to prop up their phony stock market? Or are they actually trying to trap people in bonds? So let's read a little bit more and then I'll tell you what I think. FT justifies this latest unprecedented pseudo-capital control by saying that, quote, officials are concerned that bond fund investors, as with bank depositors, can withdraw their money on demand. I already read that. The Fed's justification for this latest bazooka approach in the forced capital reallocation, quote, exit fees would seek to discourage retail investors from withdrawing funds, thereby making their claims less liquid and making a fire sale of the assets more unlikely. Oddly, there's nothing in the Fed's proposal about gating the most overvalued asset classes of all, equities, or say biotechs and Momo stocks, where the drawdowns, when they happen, are so fast and vicious the bulk of hedge funds are still down for the year precisely because they were all led like obedient sheep into the Div 0 PE slaughter. Also, memory is a little fuzzy, but in the days after Lehman, it was equity hedge funds that promptly gated all their investors. Now, that's the thing, is that these types of shutdown orders, they're not just in bond funds and money markets. They're already in the stock funds. They can stop trading the stocks. They've done it multiple times. There was a flash crash. They halted the stocks. The brokers can halt your redemptions of them, especially if they're held in street name. You don't own the share. There's any numbers of doors that can be closed on you suddenly so that you can't get your money back out. And I can guarantee you that probably many, if not all of them, are going to be used in the future panic, which is going to be obviously when this system, this gigantic bubble derivative debt system that they've built up collapses. It's going to be the biggest crash in history. So they're probably going to use all of these stops that they've put in here. Also, it goes without saying that discouraging investors from withdrawing funds is the last thing on the Fed's mind, which knows very well that when it comes to investor behavior, all that matters is how the Fed's future intentions are discounted. And with this unprecedented step, the Fed is sending a very clear message. It may be next year or next month or next week, but quite soon, you dear retail bond fund investor will be gated and will be unable to pull your money out. So Zero Hedge's opinion on this is that this is the Fed's attempt to push more money into the stock market. I'm kind of 50-50 on this one. I don't really know what their ultimate motivation is. I know that all of these things are gigantic games of musical chairs, and there definitely aren't enough chairs in the room. When the music stops, there's going to be zillions of people in 2 or 3 chairs. So they're just taking some chairs away slowly while the music is still playing. That's what's going on. And of course, we know that when the music stops, the only thing that's going to be left standing is physical silver and physical gold. Now, I wanted to jump over and visit some of the coin sites because I like to check these. These are my favorite coins of all, so I'm going to review these. I periodically check these, but I wanted to go ahead and review these and tell you my thoughts on them. So this is my favorite series of all for a number of reasons. Let me go ahead and recount those. First of all, they're Perth Mint, and I consider Perth Mint coins to be the most beautiful and well-designed coins out there. Secondly, Perth Mint coins are government-issued coins, so they actually have a face value on them. They're not just a blank or a round or something like that. Third of all, the Lunar series is a series that's made specifically with the Chinese in mind. It's based on the Chinese calendar, and I think it's going to have an appeal to the Chinese in the future going forward. And fourth, probably most importantly, they seem to be rare and they seem to retain their value very, very well. So with all that in mind, let's look at what's available. Now, I went to just 3 sites, the main ones that I check: APMEX, Provident Metals, and Gainesville Coins. So this is APMEX, and you can see the first one that we have here. This is one I've been watching very carefully, and this is the 2014 Year of the Horse. So this is a beautiful coin. There's no question in my mind. My only coin that I like better is this Tiger, and we all know what the Tiger did. But this one for me is number 2. I definitely like it above the Dragon or any other coins. So I think that 1345, let's see how many are left of these. Looks like there's a lot of them at 1600. I think 1345 is probably a can't beat it sort of deal. That's about 27 bucks. I think that silver could probably move to 25 bucks in a week's time if it started to move. So that's one. I like that. Of course, there really aren't any others until we get down to the Year of the Dragon here. And I was buying those last year for about 12 bucks, I think. Now they're up to 24. I don't know how many are left. There still are quite a few out there. Well, there's only 7 here on this site. And you have to keep in mind here, what always runs through my mind is, why are there so few of these coins? You would think that if Perth Mint was making a profit, that they would just issue as many as they can, try to make as much money as they can. But for some reason, the works always seem to be gummed up and things seem to be out of stock all the time, which is great for people like stackers, because that's just going to make them rare going forward. But it doesn't appear to be a market that's functioning properly. Now here is the 2013 Snake. These were all, I picked these up also last year, $12 and $13. And then we get down to this one here. This is the colorized Year of the Horse. And they have this one on Gainesville as well as on Provident. And you can see there's 1,600 of these coins. Now what's so striking about this is that this is actually $10 cheaper than the regular 1 ounce. Colorized have always had a premium to the other, just the straight silver coin. But you can see here, this one has a $10 discount on it. That is amazing. I don't really know what that means. Maybe it means that most people who collect coins are like me, and they actually prefer the pure silver coin over the colorized coin. But then again, at $30, $29.20 for this coin, I don't really see how you can go wrong. So then, of course, there's the 2 ounce of the Horse series, and then that's about it. That's $51.44, so that's a halfway decent deal. Definitely have to say, the best deal by far if you're willing to take a gamble. And I really don't think it's that much of a gamble. After all, you're only talking about, you know, $10 over spot, about $8 more than other coins is this colorized Year of the Horse. So next we have Provident Metals, and you can see there aren't really a lot available, same as everywhere else. You can see about the same price on the 1/2 ounce Horse, a little bit cheaper for the 1/2 ounce Dragon. The Snake is actually at a decent premium to the Dragon, which is kind of interesting to me. I thought there would be more demand for the Dragon, but that might just be an anomaly caused by suppliers for them. And then we're out of stock, and we have the 1 ounce Year of the Horse, the regular edition, going for $42.70, and then we get the 1 ounce Dragon there for $47.95, and the 2 ounce Horse. Here's a 1/2 ounce Tiger from 2010. That's a 1/2 ounce at $54.86. So apparently they're getting almost $55 for that. Here's a 1 ounce Tiger, and actually I think that that's a decent price at $70. I wouldn't recommend anybody get that, but that just shows you how much appreciation these coins have. Now remember, people always say, well, you can't sell them for that. No, if you go to eBay and compare, they're roughly close. You're not going to be able to sell them to APMEX or Gainesville for that amount, but if they're selling them for that, that means people are paying that amount of money. And last of all is Gainesville coins. You can actually put a check mark in this box for in stock only. And again, a very sparse selection. You can see here that here's the half-ounce colorized snake. So that's the same pattern that we saw elsewhere, in that the colorized coin is actually cheaper. The half-ounce snake over on the other side was 23 bucks. This is $5 cheaper than that. Maybe worth a gamble. Still, just like the colorized 1 ounce is run about 10 bucks total over spot. There's the year of the dragon half-ounce, same thing there. Here's the colorized again. They were 29 something over on APMEX, 29.75 here. So they've got, I think I checked earlier, they've got like 700 of them. And then that's about it. You can see that the 1 ounce tigers over here are $87. So again, this is the coin that I watch the most closely is the Lunar Series 2, and it's my favorite coin. I already gave you the reasons. So definitely I'm interested in those colorized ones. I may pick up a few for myself. Back to the chart, we're waiting on that resolution from the MACD to get that crossing up. I'm projecting that if we do get a move to $22 between now and the end of August, we will get a cross of that. I can't say for sure because that's a very, very slow moving average crossover system. It's like turning around the Titanic or something. But my guess is if we get a move to 22, we will get that cross, and that's going to project a very big run in the future. And we'll talk to you next time.